Most people work hard for money while their money does almost nothing. That is the part that bothers me. Think about the ordinary day. You wake up at 7 in the morning. You spend time getting ready. You spend an hour getting to work. You work 8 hours. Then you spend another hour getting home. By the time the day is finished, you may have given 10 hours of your life to the process of earning money. Then ask the obvious question, what did your money do during those same 10 hours? For many people, the answer is almost nothing. It sat in a checking account. It sat in a savings account. It earned barely enough interest to notice. It looked safe because the balance did not move much, but in real terms it was quietly losing power while the person who owned it was working himself to exhaustion. That is not a fair system. But it is the system most people live in because they never create a structure that makes money work when they are not working. They work, their money sleeps, they get tired, their money stays idle, they try to save. Inflation takes a piece, they wait until they feel ready to invest, the years pass. And by the time they finally realize that cash sitting still is not truly safe, the cost of waiting has already compounded against them. This is why the first real milestone is not $1 million. It is not even $100,000. For many people, the first serious milestone is $10,000. $10,000 is not enough to make you financially free. It is not enough to retire. It is not enough to make you wealthy in the way people imagine wealth. But it is enough to do something more important. It is enough to build a system. That is why $10,000 matters. It is the first amount large enough to feel serious, but still small enough that a normal person can reach it. It is the amount where you can finally stop thinking only like a saver and start thinking like an allocator of capital. That shift matters. Saving is defensive. Asset allocation is strategic. Saving says, I am trying not to lose what I earned. Asset allocation says, I am designing a machine that can grow what I earned. Those are very different ways of seeing money. And if you never make that shift, you will spend your life chasing money instead of gradually building a machine that chases freedom for you. I want to be very clear. I am not talking about day trading. I am not talking about staring at stock charts all day. I am not talking about chasing hot stocks, gambling on headlines, or waking up every morning terrified that one bad market move will destroy your future. If your investments keep you awake at night, that is not investing. That is self-inflicted stress. A good asset allocation system should be almost boring. It should be like setting a washing machine. You choose the cycle, you put the clothes in, you press start, then you leave it alone and allow the process to work. That is what most people need. Not excitement, not constant action, not a feeling of genius, a system. Because without a system, people do one of two things. They either leave money in the bank where inflation quietly weakens it, or they rush into random investments because a friend, a video, or a headline made something sound urgent. Both are dangerous. Money sitting in the bank may feel safe, but it can lose purchasing power every year. Money thrown into random investments may feel bold, but it can be destroyed by lack of planning. The answer is not fear. The answer is structure. So let us start by removing the myths. The first myth is that saving is safe and investing is dangerous. This sounds reasonable because the bank account looks stable. If you put $10,000 in the bank, the number still says $10,000 tomorrow. It may even say slightly more after interest. That visible stability makes people feel protected. But money is not measured only by the number printed on the screen. Money is measured by what it can buy. If inflation is around 3.3% and the average one-year fixed deposit is yielding about 1.9%, then your cash is not really growing. It is shrinking in purchasing power by roughly 1.4% a year. After 10 years, that same $10,000 may have purchasing power closer to $8,700 in real terms. The number may look safe, the value is not safe. That is the danger of cash. Cash tells you a comforting lie. It says, I am still here. But inflation quietly says, you can buy less. Most people feel that erosion without naming it. They go to the store and notice that the same groceries cost more. They renew insurance and the bill is higher. They pay rent and the increase is bigger than their raise. They keep money in the bank and wonder why life still feels more expensive. That is because cash without growth is vulnerable. Saving is necessary, but saving alone is not a complete plan. Cash is a tool for liquidity, emergencies, and short-term needs. It is not a long-term wealth engine. The second myth is that you need a large amount of money to start investing. Many people think they should not begin until they have $100,000 or more. That is backwards. If you wait until you have a large amount before learning how to allocate money, you may reach that amount with no process, no discipline, and no understanding of risk. $10,000 is a good starting point because it is meaningful enough to take seriously and small enough to learn with. It is like going to the gym. You do not refuse to lift because the dumbbells are only 10 pounds. You use the 10-pound dumbbells to build form, rhythm, and consistency. Later, as your strength grows, you can lift more, but the form comes first. Money works the same way. The first $10,000 teaches you allocation. It teaches you volatility. It teaches you patience. It teaches you how to divide money into different jobs. It teaches you that every dollar should have a role. Some dollars protect you, some dollars grow, some dollars wait for opportunity. This is the beginning of financial architecture. The third myth is that investing means constant research, stock picking, and stress. If you are a professional investor, you may spend your life studying companies, reading filings, building models, assessing management, and trying to find mispriced assets. That is a serious craft. But most people working ordinary jobs do not need to turn investing into another job. Your time is valuable if you spend 3 hours every night researching individual stocks. But you do not understand what you are doing, you may not be improving your returns. You may simply be increasing anxiety. For many people, the wiser move is to use broad market ETFs, low-cost index funds, automatic investing, and scheduled rebalancing. The core spirit of passive investing is humility. It says the market is smarter than I am in the short run. I do not need to beat it. I need to participate in it. That humility is powerful. Most investors underperform not because the market is impossible, but because they interfere too much. They buy when excited, they sell when afraid, they trade too often, they chase recent winners, they abandon the plan during downturns, they listen to noise and confuse movement with progress. The best strategy for many people is the most boring one. Buy, hold, rebalance, keep learning, do not overreact. That sounds simple, but simple is not the same as easy. The difficulty is emotional. That is why the system matters. A system protects you from your own worst impulses. Now let us return to $10,000. If you have $10,000, the first question is not, what single thing should I buy? The first question is, what jobs must this money perform? That is how I think about it. Money should not sit in one pile with one vague purpose. Money should be assigned. Some money must protect you from emergencies. Some money must grow for the long term. Some money must remain flexible so you can act when markets give you an opportunity. That is why the allocation is divided into 3 layers. The safety net, the growth engine, the opportunity bullets. This is a simple structure, but it solves several problems at once. The safety net gives you psychological security. The growth engine gives you long-term compounding. The opportunity bullets give you flexibility when fear creates better prices together. They create balance. And balance is what allows you to stay invested. A lot of people fail at investing not because the assets were wrong, but because their personal system was fragile. An emergency appears, the car breaks, a pipe bursts, a job is lost, a medical bill arrives because they have no cash reserve. They are forced to sell investments at the wrong time. They sell during a decline, lock in losses, and then tell themselves investing is dangerous. But investing was not the original problem. The lack of a safety net was the problem. This is why the first layer is the safety net. With $10,000, I would hold back 20% or $2,000 as emergency cash. This money is not for growth. It is not for excitement. It is not for opportunity. It is not for speculation. It is there to keep the rest of the system alive. It can sit in a high-yield checking account, a savings account, a short-term fixed deposit, or another liquid safe vehicle. It should be accessible. It should be boring. It should not be exposed to stock market volatility. Some people look at that $2,000 and say, is that not wasted money? Number, it is not wasted. It is insurance against forced selling. The return on emergency cash is not only the interest rate, the return is the panic it prevents. When you know you can handle a car repair, a home repair, or a temporary income disruption, you are less likely to touch your long-term investments during market stress. That is valuable. Liquidity creates emotional stability. Emotional stability lets you hold productive assets. Holding productive assets lets compounding work. So the emergency fund is not separate from the investing plan. It is the foundation that protects the investing plan. If you sprint at the beginning of a marathon, you may collapse before the later miles. Investing is a marathon. The safety net lets you keep a steady pace. The second layer is the growth engine. This is the core of the portfolio. With $10,000, the growth engine receives 60% or $6,000. The goal of this layer is long-term growth. This is not money for next month's rent. This is not money for a vacation. This is not money for a car down payment you need soon. This is money meant to participate in the long-term growth of productive assets. The source strategy divides this $6,000 into a 70-30th structure. 70% goes to broad stock market ETFs, such as funds tracking the total market or large U.S. companies, including examples like VTFEOO or VTI. 30% goes to bond ETFs or investment-grade corporate bonds. Why this structure? Because stocks and bonds have different jobs. Stocks are the growth engine. They represent ownership in businesses. Over long periods, broad stock markets have often produced strong returns, sometimes in the range of 8 to 10% annualized, though not in a straight line and never guaranteed. Stocks are volatile because businesses, earnings, interest rates, sentiment, and the economy all change, but they are where long-term wealth often compounds. Bonds are the stabilizer. They usually have lower returns, perhaps in the 3 to 5% range depending on the environment, but they can reduce volatility and provide ballast. When stocks fall, bonds may hold up better or even rise, depending on the type of bond and interest rate environment. The point is not that bonds are exciting. The point is that bonds can help you stay in the game. If your portfolio falls too much and you panic, the theoretical return of stocks does not help you. You sold the plan, failed. A balanced portfolio may grow more slowly than an all-stock portfolio in strong bull markets. but it may be easier to hold through downturns. That is the real test. Not what the spreadsheet says when markets are calm, what you do when your account is down 30%. A 70/30th stock to bond portfolio is a classic structure because it gives growth while reducing some stomach, churning volatility. It is not perfect. No allocation is perfect. But it is a reasonable framework for someone who wants long-term growth without turning every market decline into an emotional crisis. Now, there is another important rule. Do not obsess over buying at the perfect low. Timing the market consistently is extremely difficult. Even professional managers struggle to do it. The danger for ordinary investors is that waiting for the perfect entry becomes an excuse for doing nothing. They wait for a crash, then when the crash comes, they are too afraid. Then the market recovers and they feel left behind. The better approach is dollar-cost averaging with the $6,000 growth engine divided across 6 months and invest $1,000 each month. That way, if the market falls after the first purchase, you still have future purchases at lower prices. If the market rises, you are at least participating instead of sitting entirely in cash. Dollar-cost averaging is not about maximizing returns under every possible scenario. It is about reducing regret and building discipline. It helps you begin. And beginning matters. A system that gets implemented imperfectly is often better than a perfect plan that stays in your head. The third layer is the opportunity bullets. This receives the final 20% or $2,000. This is flexible capital. It is not the emergency fund. Do not confuse the two. The emergency fund protects your life. The opportunity fund allows you to take advantage of market fear. The rule in the source is simple. When the broader market drops more than 15% from its peak, begin deploying the opportunity fund in batches. That is an intelligent way to define action before emotion takes over. If you wait until the market falls to decide what you believe, fear will dominate. A decline of 15% will feel worse than it looks on paper. Headlines will be negative. People will say the market is going lower. You will feel pressure to wait. But if you created a rule in advance, you do not need to debate yourself in the middle of fear. The system says what to do. That is the purpose of the opportunity bullets. When markets are calm, the money can sit in a money market fund, short-term ETF, or other relatively safe interest-bearing vehicle. It may earn 2 or 3% while it waits. It is not completely idle, but its real value appears when everyone else is panicking. In 2022, when the stock market fell, many people were afraid, but a person with opportunity cash could buy more. When the market recovered in 2023, those purchases may have gained significantly. The exact result depends on timing and assets, but the principle is clear. Cash during a crash becomes power. Cash before a crash feels boring. That is the trade-off. Most people want every dollar fully invested when markets rise. Then when markets fall, they wish they had cash. A 20% opportunity reserve accepts the cost of having some dry powder so that you can act when prices are better. This is not about predicting crashes. It is about being prepared when they happen. Now let us summarize the structure. 20% safety net, 60% growth engine, 20% opportunity bullets on $10,000. That means $2,000 in emergency cash, $6,000 in the core investment portfolio, and $2,000 reserved for market dips. Within the $6,000 growth engine, 70% goes to stocks and 30% to bonds. That means $4,200 toward broad stock ETFs and $1,800 toward bond ETFs or investment grade bonds deployed over 6 months at $1,000 per month. That is a system, not a guess. And because it is a system, you can operate it without asking permission from your emotions every week. Now, implementation matters. A plan is not real until it is executed. The first step is opening a brokerage account. Today, this is not difficult. Most major brokers allow online account opening. You need identification, bank account information, and basic personal information. The process may take minutes. Look for a broker with low fees, a user-friendly platform, strong reputation, and access to low-cost ETFs or mutual funds. Do not let the process intimidate you. The brokerage account is not the wealth. It is the container. The second step is setting up automatic transfers. This is crucial because human nature is unreliable. If investing requires a fresh decision every month, you will eventually delay. You will say next week. You will say after the bill. You will say after the market calms down. You will say after the election. You will say after the next paycheck. Automation removes negotiation. The money moves according to the rule. It is like an automatic mortgage payment. At first, you notice it later. You adjust your life around it. That is exactly what you want. You want investing to become part of the normal rhythm, not a heroic act that depends on motivation. Motivation is weak. Systems are stronger. The third step is selecting the ETFs. Do not overcomplicate this. If you do not know what to pick, a total market ETF can be enough. VTI gives broad U.S. total market exposure. VO tracks the SP 500. VT gives global stock exposure. Each has a different structure, but all reflect the same basic philosophy: own broad, productive markets at low cost. There is no perfect asset. There is only the asset that fits the plan. Many people waste months comparing whether one broad ETF is marginally better than another. That time might be better spent starting. The differences matter, but not as much as discipline, contribution rate, fees, and time. The danger of seeking the perfect fund is that you never buy any fund. Action matters. The fourth step is rebalancing. Suppose your core portfolio begins as 70% stocks and 30% bonds. After a strong stock year, stocks may rise to 80% and bonds may fall to 20% of the portfolio. That means the portfolio has become riskier than intended. Rebalancing brings it back to the plan, to rebalance. You may sell some of what grew and buy some of what lagged. That feels counterintuitive. It feels like selling winners and buying losers. But that is the point. Rebalancing forces discipline. It prevents greed from letting winners become too large and fear from causing you to abandon what is temporarily weak. It is a mechanical way to sell relatively high and buy relatively low. The source suggests rebalancing once every 6 months. That is reasonable for many people. It is not too frequent, but frequent enough to keep the portfolio aligned. Some people rebalance annually. Some rebalance when allocations drift beyond a threshold. The exact method matters less than having a method without rebalancing. Your risk level may change without your permission. That is dangerous. The fifth step is to keep learning but not overreact. Investing is a lifelong process. You should learn. You should understand market shifts. You should know what inflation, interest rates, recessions, and valuations mean, but you do not need to check charts every day or change the portfolio every week. The source suggests 1 or 2 hours a month reading financial material or watching educational content to understand macro trends. That is enough for many people. The goal is awareness, not obsession. Retail investors often underperform the market by 3 to 5% because of frequent trading and emotional decisions. That underperformance is not caused by stupidity. It is caused by behavior. They buy high, they sell low, they overreact, they chase, they abandon boring strategies because boredom feels like failure. But boredom can be an advantage. The best investment strategy is often the one that looks least exciting while it is working. Buy, hold, rebalance, keep adding. That is the discipline. Now, what kind of returns might this system produce based on historical data? A 70 divided by 30 stock to bond portfolio has often produced long-term annualized returns in the range of 6 to 8%. The source uses 7% for illustration. At 7% annualized, $10,000 becomes nearly $20,000 in 10 years. In 20 years, it becomes more than $38,000. In 30 years, it becomes more than $76,000. That is without adding any more money. This is already meaningful because it shows how money can work even without addition. But the real power appears when you keep adding. If, in addition to the initial $10,000, you invest $200 every month, the total can grow to more than $300,000 in 30 years under the 7% assumption. That is the power of compound interest plus contributions. The initial capital starts the engine, the monthly contributions feed it, time multiplies it. This is why $10,000 can become the starting point for financial freedom. Not because the amount is enormous, because the system attached to it can be enormous over time. Now, there will be market declines. This must be said honestly. You will see paper losses. You may see your account fall 10%, 20%, 30%, or more. It will feel unpleasant. When the pandemic first hit in March 2020, many accounts fell more than 30%. That was frightening. People did not know what would happen next. Businesses were closing. The economy was uncertain. Fear dominated. But those who stayed invested and continued following the system participated in the recovery. The lesson is not that every crash recovers immediately. The lesson is that emotional selling during panic can destroy a good long-term plan. Your biggest enemy in investing is usually not the market. It is your reaction to the market. This is why asset allocation matters. If you have bonds, cash, and opportunity reserves, you may be able to withstand the decline without selling the growth assets. If you are all in on volatile assets with no cash, a crash may force emotional action. The system is designed not only for returns, it is designed for survival. Survival is the first rule. You cannot compound if you quit. Now let us talk about human capital. Your investments matter, but your ability to earn is also a major asset. If you are 30 years old and make $60,000 per year until age 65, that is $2.1 million of gross labor income before raises. Your future earning stream may be larger than your current portfolio by far. That means investing in yourself can be one of the highest return decisions you make. Learn skills, build a network, improve your communication, gain experience. Increase your value in the marketplace, move into better paying roles, start a side business if appropriate, negotiate, certify, adapt. The more you earn, the more fuel you can put into the investment machine. A person earning $60,000 and investing $200 a month may do well. A person who raises income to $120,000 and controls lifestyle can invest far more. The compounding accelerates because the fuel increases. The source gives an example of a friend who started with $10,000 but also worked hard to improve his professional skills. Over a few years, his salary rose from $60,000 to $120,000. Because his income increased, he could invest more each year. By age 38, his portfolio was over $100,000 and growing. That is the combination human capital plus financial capital, earning power plus investing system. Too many people focus only on portfolio returns. They obsess over whether an ETF will return 7% or 8%, while ignoring the possibility of doubling their income. In the early and middle stages of wealth building, income growth can matter more than portfolio optimization. This is a systems view. Do not rely only on the portfolio, build the person who funds the portfolio. Now, let us connect the whole strategy. The three core concepts are simple: diversify risk, hold long-term, execute with discipline. Diversification protects you from relying on one thing. Long-term holding lets compounding work. Discipline prevents emotions from destroying the plan. The $10,000 allocation reflects those principles. 20% in the safety net, 60% in the core portfolio, 20% in opportunity bullets. Automatic transfers make execution easier. Dollar cost averaging reduces timing regret. Rebalancing every 6 months keeps risk aligned. Learning without overreacting keeps you aware, but not anxious. This strategy will not make you rich overnight. That is not the point. Overnight wealth is usually either luck, leverage, speculation, or survivorship bias. Durable wealth usually comes from systems, time, discipline, and growing earning power. The goal is not to impress people this year. The goal is to give your future self more choices. That is the true meaning of financial management. Not simply becoming rich choice, the ability to say no to a bad job, the ability to handle emergencies, the ability to help family, the ability to retire with dignity, the ability to stop measuring every decision by immediate financial fear. The ability to use time according to your values, that is what money is for. And it begins when your money stops sleeping all day. Now, let us address fear. Putting $10,000 into a system may feel scary. That is normal. If you worked hard to save the money, it is natural to be cautious. Fear is not a sign of weakness. It is a sign that the money matters to you. But fear should lead to a better system, not permanent inaction. If you do nothing and leave the $10,000 in the bank for 10 years, inflation does not wait for you to feel ready. It keeps moving. Your purchasing power keeps declining. The world keeps getting more expensive. Doing nothing is also a decision, and it has a cost. The difference is that the cost is quiet. A market decline is loud. You see the red number, you feel the pain. Inflation is quieter. It takes away purchasing power slowly, without dramatic alerts. That is why people underestimate it. But quiet losses are still losses. So instead of watching the money lose value passively, put it to work intelligently, not recklessly, not all at once without thought, not in random hot stocks, inside a system. That is the distinction. Now suppose you are not ready to invest the full $10,000 immediately. That is fine. The strategy already uses dollar cost averaging. You can begin with a portion. You can start with $100 or $200 per month. The point is not to do everything perfectly on day one. The point is to begin building the habit and structure. Once you start, the fear often shrinks. The process becomes familiar. You learn how the account works. You see the automatic transfers, you see dividends appear, you see volatility, you survive the first downturn, you rebalance, you begin thinking like an owner. That experience changes you. The first time investment income appears, even if it is small, the relationship with money changes. You realize money can earn money while you sleep, rest, work, or spend time with family. It may be only a few dollars at first, but psychologically it matters. It proves the machine exists. The amount is not the miracle, the direction is the miracle. You have moved from pure labor to ownership. That is the beginning of passive income. Now let us talk about why people fail after starting. The first reason is lack of emergency cash. We already covered that. Without a safety net, emergencies force selling. The second reason is unrealistic expectations. People expect quick gains. When the portfolio moves slowly, they become disappointed. But compounding is slow early. The first years are the foundation years. If you quit because the early results are not dramatic, you never reach the part of the curve where growth becomes visible. The third reason is overchecking. If you check the portfolio every day, the market's normal noise begins to feel personal. You start thinking every red day requires action. It does not. The market is always moving. Most movement does not matter to a long-term investor. The fourth reason is copying others. A friend mentions a hot fund, a video talks about a stock, a headline says one sector is exploding. Suddenly, the plan is abandoned. The investor moves from system to impulse. That is usually where mistakes begin. The fifth reason is no rebalancing. When stocks rise, people let them become too large. When they fall, fear appears. A rebalancing rule prevents the portfolio from drifting too far from the intended risk. The sixth reason is not increasing contributions. People start with an amount and never raise it, even as income grows. If your earning power increases, the investment system should receive more fuel. Otherwise, lifestyle inflation consumes the raise. These failures are avoidable, but they require discipline. Now, let us think about the 20 divided by 60 divided by 20 model as a psychological design. 20% safety net tells your mind, I am not reckless. 60% growth engine tells your future, I am building. 20% opportunity bullets tells your instincts. If the market falls, I can act. This matters because investing is not only numbers, it is psychology. A person who feels safe can hold through volatility. A person who feels prepared can buy during fear. A person with rules can avoid emotional decisions. The allocation is partly financial and partly behavioral. That is why it works. Not because 20 divided by 60 divided by 20 is the only possible allocation. It is not. But because it creates a balanced relationship between safety, growth, and opportunity. A person with no safety panics. A person with no growth falls behind inflation. A person with no opportunity cash feels helpless during crashes. The three layers solve three different problems. Now let us talk about whether someone should use exactly 20 divided by 60 divided by 20. Not necessarily. A person with no emergency fund may need more than 20% in cash at first. A person with a stable job, high income, and separate emergency reserves may invest more than 60%. A retired person may need more bonds or cash. A young person may choose more stocks. A person with high interest debt may need to pay that first. A person saving for a house may need more short-term safety. The model is a starting framework. It is not a religious rule. The important principle is to assign roles, safety, growth, opportunity. Your exact percentages should reflect your life. Now, let us discuss the 70 divided by 30 stock bond split inside the growth engine. This is also a framework, not a commandment. A young aggressive investor might use 90 divided by 10 or 100% stocks. A conservative investor might use 60 divided by 40 or 50 divided by 50. A person near retirement might hold more bonds and cash. The right allocation depends on time horizon, risk tolerance, income stability, and goals. But 70 divided by 30 has one advantage. It is aggressive enough to grow, but not so aggressive that every downturn feels catastrophic for many ordinary investors. That balance is more sustainable than an all-stock portfolio. A slightly lower return that you can stick with is better than a higher theoretical return that you abandon during the first serious decline. This is another principle. Sustainability beats theoretical perfection. Now let us talk about choosing between VTVOO and VTI. VTIVOO tracks the SP 500, giving exposure to large U.S. companies. VTI tracks the total U.S. stock market, including large, mid, and small companies. VT gives global exposure, including us and international stocks. None is automatically best for everyone. VTI is simple and focused on large U.S. companies. VTI is broader across the U.S. market. VT is globally diversified. A person who believes in U.S. dominance may prefer VTI. A person who wants global diversification may prefer VT. The decision should reflect philosophy, risk tolerance, and desire for international exposure. Do not spend months paralyzed by this choice. The bigger error is often failing to invest at all. Choose a reasonable broad fund, keep costs low, and build the habit. Now, let us talk about bonds. Some people dislike bonds because stock returns are higher over long periods. But bonds are not only about return, they are about stability, liquidity, and emotional endurance. If bonds help prevent panic selling, they may improve real-world results, even if they reduce expected return. Bonds can also provide dry powder during rebalancing. If stocks fall and bonds hold up better, selling some bonds to buy stocks can rebalance into lower prices. That is a disciplined way to buy when fear is high. But bond risk exists too. Interest rate risk matters. Credit risk matters. Duration matters. Inflation matters. Not all bonds are the same. Investment-grade bonds are different from high yield bonds. Short-term bonds are different from long-term bonds. Government bonds are different from corporate bonds. Again, understand the job. The bond portion is not meant to be the exciting part. It is the stabilizer. Now let us talk about the opportunity fund rule. A market decline of more than 15% from peak is the trigger in the source. That is a useful rule because it is specific. If the market drops 5%, maybe you do nothing. If it drops 15%, you begin deploying in batches, maybe 1/3 at 15% down, another third at 20% down, and another third if it falls further. The exact method can be decided in advance. The key is not to use all the bullets at once. Deploy in batches. Why? Because the market can keep falling after you buy. If you spend all opportunity cash at the first decline, you may have no capital left if prices become even more attractive. Batch buying preserves flexibility. This is how to act without pretending you know the bottom. Again, no prediction, just process. Now let us talk about the role of money market funds for the opportunity cash. If opportunity money sits in cash, it may earn little depending on the environment. In higher rate environments, a money market fund or short-term treasury ETF may provide yield while maintaining relative safety and liquidity. That can make waiting less painful. But safety and liquidity matter more than chasing yield. This money must be available when markets fall. Do not put opportunity cash into risky assets. If your opportunity fund falls at the same time as the market, it cannot play its role. Every dollar needs a job. Opportunity cash must remain ready. Now let us talk about the first dividend payment. It may seem small, maybe a few dollars, maybe less, but psychologically it is important. It is the first time the system pays you without direct labor. You did not clock in for that dividend. You did not drive to work for it. You did not trade an hour for it. It came because you owned an asset. That experience can change how you think about money. You begin seeing money not only as something to spend, but as something that can produce. You begin seeing investments as trees. You plant them. They grow slowly. Eventually, they bear fruit. If you reinvest the fruit, you plant more trees. This metaphor matters because it changes behavior. A consumer eats the seed, an investor plants it. Now, let us discuss patience. Patience is not doing nothing. Patience is letting the system work after you have done the right setup. There is a big difference. If your money sits in a bank earning less than inflation, doing nothing is not patience. It is inaction. If you have a diversified portfolio, automated contributions, periodic rebalancing, emergency cash, and a long-term plan, then not touching the portfolio every day is patience. The same outward behavior can have different meaning depending on the system behind it. This is why the setup is so important. Once the system is set, your job becomes simpler. Do not sabotage it. Now, let us talk about financial freedom. Financial freedom is not only a number, it is the power of choice. When you have assets working for you, your daily stress can shrink. You may still work, but you are not as dependent. You may still face uncertainty, but you have reserves. You may still experience market declines, but you have a plan. Choice is the real dividend. Money that works for you gives you choices. Choices create dignity. That is why asset allocation matters. It is not just about turning $10,000 into $300,000. That projection is useful. But the deeper point is to change the direction of your life. Instead of chasing money forever, you begin sending money ahead of you to build a future. This is how a normal person becomes financially stronger, not overnight, over decades with a system. Now, let us speak honestly about the limits. A 7% return is an assumption, not a guarantee. A 70 divided by 30 portfolio can still decline. Bonds can fall, stocks can crash, inflation can surprise. Taxes can reduce returns, behavior can sabotage the plan, fees matter, account choice matters, life emergencies happen. That is why the strategy includes safety, growth, and opportunity. It is also why you must keep learning, but learning should improve the system, not constantly destroy and rebuild it. Some people mistake constant changes for sophistication. Often they are just reacting. Sophistication is knowing when not to act. Now, what should someone do today if you have $10,000? Do not ask which hot stock will make you rich. Ask how to allocate the money into a system. Set aside the safety net, build the growth engine, keep opportunity bullets, open the brokerage account, select broad low-cost ETFs, automate transfers, use dollar cost averaging, schedule rebalancing, keep learning monthly, avoid overreacting, increase contributions as income grows. If you do not have $10,000 yet, the principle still applies. Start with smaller numbers. Build the safety net, open the account, begin with $100 or $200 per month. If that is what you can do, the point is to start building the machine. Do not wait until you feel completely ready. You will rarely feel completely ready. The market will always have risk. The economy will always have uncertainty. There will always be a reason to delay. If you wait for perfect emotional comfort, you may wait your whole life. The best time to invest was years ago. The second best time is when you have a reasonable plan and enough stability to begin. That may be today. Now, let us end with a central picture. You work 10 hours a day for money. If your money sleeps during those same 10 hours, you are carrying the entire burden yourself. But if $10,000 becomes a system, part of your financial life changes. $2,000 protects you, $6,000 grows. $2,000 waits for opportunity, monthly contributions add fuel. Rebalancing keeps the machine aligned. Your career growth increases the fuel, time compounds the result. The system is not dramatic. That is why it works. Most wealth is not built by constant drama. It is built by quiet, repeated actions that look unimpressive until enough time passes. One day the dividends arrive. One day the balance crosses a milestone. One day, the account grows more in a year than you used to save. One day your money earns while you are doing something else. That is when you understand your money was not meant to sleep, it was meant to work. And $10,000 allocated correctly can be the moment you stop chasing money with every hour of your life and begin building a machine that works beside you. That is the lazy way, but it is not lazy in the sense of being careless. It is lazy in the right way. Simple, automated, disciplined, boring, patient. A system that lets you live your life while your capital does its job. And if you keep feeding that system, $10,000 can become far more than a balance in an account. It can become the first serious step toward financial freedom.